everyone. Today the topic which we have chosen is something related to trading, especially futures and options trading. So, session number 90, we are discussing who makes money in futures and options trading, especially the very dark secrets related to this F&O tradings is been very well discussed in this session. I will not be unnecessarily taking your time by discussing what is the technicalities related to futures and options trading, what is a future, what is an option, how to trade in that, what is a call option, what is a put option, what is a derivative. All these things you are very well aware, and if you are not aware, you have got excellent market gurus available on the trading platforms in YouTube or other platforms, wherein you can easily get the details related to this, technicalities related to this trading, especially for futures and options. What I am going to discuss here is completely different. The revelation is basically on who really makes profit in all these trades, especially the futures and options trading. No doubt, it is very clear that you or we retail investors or retail traders are definitely not making the profit. The major profit is always taken away by the institutional investors. Don't worry about it, we'll discuss everything in detail as always. So these days you can see there are a lot of trading gurus. They call themselves trading gurus. They speak a lot in YouTube. You can get analysts and other gurus talking in TV channels, media, and majority of the things are forged, I would say. Now why so? All these things we'll be discussing in this video. So for me, stock market is not just about making money. It's about participating in the global economy and supporting the growth of innovative companies. So what all you will be learning in this video? First thing, you will be learning the reality of futures and options trades, who are real profit makers in the market, especially using these trades, who are institutional investors, trading strategies adopted by these institutional investors to beat the retail investors and take off all the profits, how stock market is manipulated by the big players, which is the institutional investors. After that, we'll be doing some trade data analysis, wherein how you can go to NSE website and see the various trade or the long short positions of various institutional investors and how to utilize that for analyzing your own trades. And finally, major takeaways for the retail investors as far as the dark secrets of F&O trades are concerned. So, reality of futures and options trades. So, if you see, everyone tells you how to earn so-called infinite profit by just trading in options, or in that case, future trading as well. They exploit the fact that poor retail investors get to rejoice their adrenaline rush in their body to trade in great options. I personally know none who have made net profit using F&O trading other than the big short investors or some market gurus who tell that they have made a lot of profits in this year and you should also try it out and adopt their courses and pay them and make them profit. Reality remains the same. Majority retail investors are set to lose. So now the question is, if retail investors are not making profit but lose money, then who is actually making the money out of all these trades? As trading is a net zero game or a zero sum game, means one gains and the other loses. Means if somebody has to make profit, then he has to make profit by getting money from someone else who loses. So a trader makes profit simply means someone else who is trading is making a loss. If you see, almost 95% of retailers make loss as per the data analysis. In this session, I will decode the darkness behind the F&O trading and how retail investors like us are conveniently fooled. We don't leave it there. I also tell you what are the strategies or where all we have to see the things or the questions by the great investors or the institutional investors who are really making the profit, and how to counter all those things and don't get trapped in them and lose your money. As always, stay away from such trades, take a long view, be a long-term investor to intelligently beat the market. So as always, my channel, our channel is for long-term investors, for value investors who pick the stocks at its inflection point, make multi-bagger returns, and never for who look for short-term trades for satisfying his adrenaline levels. But end of the day, after taxation and after other charges, they hardly don't earn anything but just tension and stressful life. Have you ever checked the real profit and loss statements? That is the P&L statements of these so-called traders who make profit, the retail uh, investors who are claiming that they are the market gurus or who are the top traders. Have you ever checked the real P&L? These days they are coming up with fabricated P&Ls wherein the profits and other things are really forced. They come up with zero the accounts and all wherein they show they have done the profit, but majority of them are forged. Stock market is home to various key players such as institutional investors, retail investors, operators, and market makers. They actually shape the market. Volume or quantity or position of trades the big investors make, the big institutional investors make is much larger compared to retail investor positions because they have the liquidity, they have the cash holding position, unlike the comparatively poor retail investors. Also, the institutions take the positions based on comparatively a longer time frame, say 1 week to 1 month, compared to a daily trade basis. These institutions have longer term research analysis, which is better predictable than just wild guess, unlike a retail investor. Institutions have got their own research cell, they have their own insider information, they are the big shots, so they have got all the additional information upfront, and they get all this data much before the thing comes up in the news or the retail investors comes to know about this. Institutions majority of time wins the trade versus the retail traders. So on the screen, if you see 89% or 90% of retail traders in F&O suffered losses in financial year 2022. This is done by a SEBI study report which is given out in January 2023. The same thing, the news has come in another media. So this is like, if you see, the retail traders are not supposed to make profit in majority of the trades. So as I told, some 9 to 10% who is making the profit is a few people out of the large chunk of retail traders. So you can see some top end traders who are completely into this, dedicated their life for this. So they are actually making some real time profits. But if you compare it to the majority of retailers, they are making big losses. So who are the profit makers in the market? Obviously, not you retail investors. So who? Yeah, you got it. The big institutional investors. So if you see the trade, the trading is always a war between small time retail investors, which is normally called the dump money, versus the mighty institutional investors who is having the smart money, because they know many things which the poor retail investors don't know. So they park the money and do the trade, and the losses is always majority times incurred by these small retail investors who is having the dump money. So that's why it's called dump money versus the smart money. It's a sarcastic approach of mentioning how retail investors lose in trade majority of the times to the big institutional investors. On the screen, you can see a quick glance on a retail investor versus an institutional investors. So retail investors trade in small volumes. Institutional investors has got lots and loads of money, so they have got trades in larger volume because they hold money of various in large investors and various fund houses. So they have got enough liquidity. So they trade in large volumes. They can move the market. Retail investors again less control over the market. Market makers can move the market with trades. Less research in decisions. Institutional investors has got a research team of their own. For retail investors, the liquidity is high because they can exit or enter the positions because the cash which they are putting into the trades is very less compared to an institutional investor wherein low liquidity because hard to buy and sell positions because they are having huge positions, huge number of quantity of stocks or shares being traded. So they cannot just sell off and come out. There are ways by which they can come out, which we'll be discussing in the session going forward. And retail investors is free from regulation. But institutional investors are forced to disclose info to the Securities Exchange Commission, which is in case of US or in our case SEBI, wherein they have to declare what all block trades or big trades they are doing. So that is subject to regulatory approvals. So in institutional investors, if you again see some comparison, whose money do they invest? So institutional investors invest and manage other people's money, wherein retail investors like us, we invest our own money. How do they trade? Institutional investors trade more frequently and in large sums, wherein retail investors like us trade less frequently. How much do they invest? So institutional investors, as I told, deal with large amounts of money that has the ability to affect the stock market. They can move the market, they can shape the market because of that huge positions. Wherein retail investors, relatively small amount, buying and selling by a retail investor doesn't affect the stock price as such because it's a very small quantity. How much are their fees? So brokerage fees are less as are trading more frequently with bigger amounts. Because it's a large volume, so the brokerage fees are also negotiated and kept very low. But in our case, brokerage fees and commission fees are very high, even the taxations. And how knowledgeable are they? Definitely, as I mentioned earlier, institutional investors are specialist knowledge. They have their own research team, high insights, top paid analysts, wherein for retail investors have very fewer skills and knowledge base, and they have to uh, many times depend on various tips or some small information, half-cooked knowledge based on which they trade. And majority time, as I told, makes the loss. And how much access to information they have? Access to information is available on the market for the institutional investors because they are top guys, powerful guys. They know the inside information of majority of the things or the companies or the macroeconomical factors. Unlike a retail investors who has access to retail specific information only, which is actually disclosed by various companies, very less transparent manner. So this really don't help a retail investor to make much profit with such data. Now, who are institutional investors? So these are the market players. So institutional investors include big brokers, big brokerage firms, big commercial banks. So big commercial banks like Deutsche Bank or Goldman Sachs, etc. So they are like big institutions. Even our HDFC group or the ICICI group. These are like banking firms who take up are the part of institutional investors. Then comes the hedge funds. So hedge funds, we'll discuss all this in detail. Hedge funds are like they are supposed to protect the positions or the portfolio of big investors. So for them, they create various trading strategies to protect the fund. So these are like the active traders. So big brokers, big commercial banks, and hedge funds are the major active traders. Then comes the pension and endowment funds. Then insurance companies like LIC, etc. Then you have mutual funds, then exchange traded funds. So all these again are big institutional investors who has got great funding from various pool of investors. But unlike the last four, the first three are the money basically comes from HNIs and top investors. So they have more money power and hence they do active trading and they take big risk, they take big leverage and do active trading to try to give profitable trades for the investors. So the big institutions would use their own research team. In addition to that, they use algorithm based trades, otherwise called algo trades, to execute the trades. So this will actually have a lot of program based softwares wherein they find out the various trades and where to make profit, and the trade is automatically executed to have higher chances of profitability in the trades they take up. Institutions actually form 90% of the trading activities in the market, which includes block trades and other market movers. So these block trades actually really move the market and really affect the prices of the various stocks or investments which has been done. So as the big institutional investors has to actively trade and make good profits, they really has to have a liquid position. Means they need to have a lot of cash. They have to remain in cash, a percentage of their capital should be in cash, so that if there is a steep shift in the indices or the stocks they trade, if they get a chance, then they can put in a lot of money and execute that trade. So for that they should have enough liquidity or cash. So this large positions leads to deeper moves, and as they deeper move, it will actually kill the small trades of retail investors. So institutions, if you see, have got more experience and more funds. So if you see the institutions, if they have both experience and funds, then the market moves with the one who has both these things. So as I told, institutions or the institutional investors builds a belief system. Try to convince the retail investors that what they see is correct and take the trade, and these institutions goes against that trade by continuously hitting the stop losses of our retail investors trades. A buyer's stop loss is a seller's entry, and a seller's stop loss is a buyer's entry point. So if you know about trades, then this is how it works. So fundamental analysis always wins in long term. Approach market with a long term perspective and focus on sustainable growth. So now moving forward, there are various players in the game of trading. So the first is market makers. So who are market makers? So there are different players in the market. One of the player is the market makers. So market makers, they are those who brings liquidity to the market for increasing the trade volumes. They help create a market for investors to buy or sell securities. They get profited by offering to buy at a lower rate and selling at a higher rate than market price. So if these market makers are not there, then whatever you see as trade volumes in various illiquid stocks will not be there, and there will not be any trade at all. And if there is no trade, then how the institutions can place a trade and fool you retail investors and make money? So it is not possible. So market makers play vital role in bringing the liquidity to the trade volume, that is the trading volume, and then allow retailers to participate, and then institutional investors to make profit. So please take it with a pinch of salt. This is all reality I'm telling. You may not feel it good, especially a trader may not feel this correct or will not have a good feeling about this, but this is how the market runs. So that is why the actual price the market makers will not be offering. They will be offering a buy at a lower rate and selling at a higher rate. So the difference, the delta in this will be their profit. So market makers are normally typically large banks or financial institutions. The market makers are manipulators as well. For an example, if they want a stock to come down, say they have a short position, so they want to enter the stock cheap for making long-term profits. So what they do, they wait for the stock to come down to a price wherein there is large number of stop losses. Then the market makers dumps a ton of stocks in this market by selling it. So as I told earlier, the stop loss hits for retail investors. They sell out and book losses. Then the stock further slides deeply. Then the market makers enter the stock at a desirable price as set by them earlier, and then they got the stock at a lower valuation. Then others realized that the stock was not having any issue. Then retailers also buy the stock. When it goes up, then this market maker sells at a higher price. So buying low and selling high obviously makes a good trade. Another example of market makers, they may place huge volumes of trades for buying, say, at a current price of some stock. Then retail investors think that some foreign institutional investors, FII, or big institutions is buying or entering the stock. There is some good news which they don't know. Then they also place orders for buying the stock, and they actually buy the stock. Then the market makers, what they do, they cancel the trades without spending a penny. They take the stock prices up. So this is another market manipulation. So you would be thinking, what is the difference between a market maker and a brokerage firm? So brokers help to facilitate sales between two parties, and a market maker helps create liquidity or availability to buy and sell in the market. So brokerage or the broker firms like Zerodha or Upstock or SIC Direct, or in that case Angel Broking, is different, but a market maker is different. brokers make money by bringing together assets to buyers and sellers, wherein market makers makes money by the difference in the buy and sell prices, as I mentioned earlier. So we already discussed about market makers. Then comes the operators. So operators. Who are operators? So understanding market operators is very important for being successful in trades and keeping away from wrong trades. So understanding their moves are vital in stock market. These players are some of the market's most influential and powerful people, able to move stock prices and shape the entire industry. Operators refer to individuals or even institutions with significant influence over the market's direction. An operator can be a renowned institutional investor, a hedge fund, or even a group of traders working together. Operators have huge capital to invest, allowing them to move the market with their buying or selling activity. They may focus on either long term investments or even short term trades for quick profits as well. They are supposed to have both technical and fundamental knowledge of the stocks and known for their strategic thinking and risk taking capabilities. Examples of operators are like hedge funds. So they engage in high risk strategies like short selling and high leverage. So they are known for taking huge debt, which is leverage, and then risk the capital for activities like short selling and other trading activities and try to make huge profits. So if they go wrong, then there will be huge losses as well. We have seen big hedge fund managers go bankrupt or fail pathetically. So that is other part of it. Then another example of an operator is an institutional investor like mutual funds or even pension funds. But they normally take long-term approach to investing. So the approaches are long-term and their strategies are not as risky as hedge funds. If you see in the game of stock market, prices of individual stocks and hence the various indices are determined by the supply and demand, which I already mentioned in my earlier videos, and are influenced by a range of factors including company performance, industry trends, and global economic conditions, macroeconomical and microeconomical factors. So if you see, these large funded institutions take money from wealthy individuals, companies, pension funds, and invest in financial assets or financial markets. Now next comes the hedge funds. So I have given already some hints on what is in hedge fund. So hedge, the word means limiting or eliminating risk. So originally, if you see, they were designed to protect capital of investors. So basically, they were supposed to limit and eliminate the market risk. But these days, if you see, they are considered as instruments to help rich get richer by taking high leveraged, high risk strategic investments. They use futures and options positions since the capital required is very less there compared to the direct cash positional trades and exponential profit, which is leveraged, which is a property of options, wherein unlike a direct cash buy of a stock, you can have multiple leveraged option of pledging your assets and putting half of cash and half of assets and leverage the position and participate in options trade. And well, in that case, futures also, but futures has got larger capital intensity compared to options. Options you can go with various lots wherein you can make exponential profits if the trades goes well. So as these institutional investors has got huge capital, and if they use this leverage to do trade in options and futures, so they make huge profits, and these profits are basically a loss for the poor retail investors. So hedge funds are utilized mainly by rich and not common retail public investors. It's less regulated by regulatory authorities. They invest in real estate properties, swaps, stocks, stock options, futures, and contracts. Basically, option contracts. And also stock options, futures, and contracts. Even artworks as well. So, unlike mutual funds, they can take huge short positions with high leverage. Betting a stock would fall deep. They take long term investment instruments also. Going forward, major institutional investors globally includes BlackRock, the huge BlackRock, Vanguard, the mutual fund firm, State Street Global Advisors. So these are like global. And HDFC Group, Kotak Mahindra Group, Reliance Group, ICICI Group. These are like Indian major institutional investors. And if you see, global investors include a list of companies: BlackRock, Vanguard, State Street Global Advisors, as I told, JP Morgan, Capital Group, Prudential Financial, Deutsche Asset Management, Franklin Templeton, Sumitomo, Alliance, Aviva Investors, Blackstone. So these are there are various companies. Now, Indian institutional investors include the President of India, also is an institutional investor. Then SBI Group, ICICI Group, HDFC, then Abacus Funds, Franklin India, the Oriental Insurance, Central Bank of India, the VLS Finance Limited, Valiant Mauritius Partners. So there is a huge list, and also our LIC as well is in the list, having around 1,51,000 crore odd crore net worth. So net worth of other companies are also mentioned here in the right hand side. This is all in crores. So the previous one, if you see, this was all mentioned as they being the global investors, is mentioned in million euro. This is in crore. So now the trading strategies. What are the major trading strategies opted by the institutional investors? So they go for long short strategies, which can be in cash or in F&O market. Like it's like an hedging. So they go long in one, say one stock, and they also short sell the stock. So say they can take a long position on the stock or an index. So say for an example, they go long on a stock or an index and then short on the other. Like if you have, it's like an hedge. So if something goes correct, then they make profit on the long side. Means if the stock goes high or the index goes high, then they makes profit on the long side of it. And whatever short selling they have done, the position goes down, they make loss. So both the profit and losses put together, they are not making any loss or profit. So they are hedging the position. So that is one way of doing it. Now other thing is the short selling, again in cash and F&O market. Means they are betting on the downside. Means if a index or particular stock they have got an insider information, definitely they will get every data upfront. So once they get the news, they make a position. Say Adani stocks is there, to take an example. So they know that based on some reports from the Hindenburg, the stock would go low. So they shorted the stock. Now the stock goes low, they make profit. Next comes the arbitrage funds. So this can be like in one of the, say in BSE one price is there and NSE another price is there. So the difference in price they are getting is minor profit. So they can buy from BSE and sell in NSE. So the delta is their profit. So those trades are like arbitrage funds. So also these arbitrage funds these days are algo trade based, algorithm software based trades. So the difference is automatically detected by the software and they do the trade and make the profit. So the accuracy by software based trades are much higher in case of arbitrage funds. Again, now I was thinking about the long short strategy. Another example is, typical example is, you can buy future contracts of gold and then sell gold in real, which is physical gold or in cash. So if the gold prices fluctuate, then again it's an hedge. So overall they don't make any loss. Now getting back to the next one, which is bets on corporate events. So as I told, they get a lot of insider information upfront based on the corporate events, like it can be a merger, acquisition, restructuring, bankruptcy, etc. So these things they come to know and they know how the stock prices will react to this. So based on this, they take a position long short or short selling, long position, whatever. So then they successfully make a profit. Poor retail investors doesn't know all these things. So they just follow the trades by the big institutional investors thinking they will make a profit. But end of the day, the big game, they know on a larger scale what is the things and they only make the profit. Placing bets after market manipulation. So as I told, hitting the stop losses, manipulating the market, all these things are basic things which these institutions incorporate to make huge profits. If you see, a hedge fund has got huge handling fees because very rich people actually hand over their money for hedge fund managers. So they have a 2% management fee. In addition to that, they have a 20% hurdle fee. That is nothing but whatever profit they make above that threshold, whatever profit they make in extra, 20% of that profit is cut off and taken as a profit by the hedge fund manager or the hedge fund company. Now, $1 million question: how retail traders loses mostly and institutions win the trades? Now, for that, you should understand what is market manipulation. So, how stock market is manipulated by big players. So, as you rightly see here, this is the institutional investors. They simply pay with the market and they shape the market or they move the market. So, one of the ways by which the market manipulation is done is by news manipulation. So, media. So they sell the stories, they badmouth the companies, they pay the analysts and TV shows, they fund the TV shows. So it is not the ads as you think is funding the major financial channels. It is the big players, the institutional investors who fund the channel. You can see major players taking over the company, the TV channels as well as time goes by. So they artificially inflate the stock with good news, or they badmouth the stock and bring down the stock, and they create a short selling position on the uh, particular stock, and they make much profits beyond your imagination. They try to enter the stock at a lower price, so they bring down the stock if it is required. Then they bring in good news by market manipulation, and once the stock goes high, they sell the stock and make profit. If market overall dips, they just average the stock in position without manipulation and sell at a higher position. So this is also a possibility wherein inherently if the stock goes down, then they buy in large quantities and they sell once the stock goes high. But unlike a retail investor, they cannot exit their large position quickly as the price would come down so low. So what they do, they hype the stock price by pumping the stocks, by buying them in large. Then retailers think that this is some good or great news, like I told in my earlier session on money laundering. So that was session number 53, money laundering through stock market, and also session number 52, wherein dark side of the stock market was also explained by me in detail in our series. So once they start buying, when the stock valuation goes much high and reaches target price of the institutions, then they dump the stock. Basically, they sell the stock. And while dumping, they can have a short position as well in the stock. So as they already made profit by buying low and selling high, and as they dump the stocks, the price again goes down. So they create another short position, and then they even after booking profit by selling the stock, as the stock goes low, they make profit out of the short position. That's the complex level up to which the institutions manipulate or take trades to make huge profits. Also, they can manipulate the stock price to go up by placing loads or buy orders at a higher price, creating a larger volume in trade quantity. So then the retail investors think that there is a large demand for the stock, as the institutional investors are placing at a higher price, so that price may not be easily available in the market, the quantity. So by the time retail investors comes to know, so they also quotes for higher quantity. Then once the retail investor starts buying, institutional cancel this order, which I already mentioned earlier, then sell the holding stocks at a higher valuation or higher prices without putting not even a penny from their end. So again, trapping the poor retail investors. So it's the money of retail investors. Basically, the trades lost by them is the trades actually gained by the huge institutional investors. So if you see, the hedge fund managers can see all the stop losses of all the trades the retail investors or the other investors make, and they create short positions. Then make it hit the stop loss by dumping shares and selling them, and then with stop loss hit, all the retail investors will have to exit the position, which I already mentioned earlier, and by selling their positions in the loss, then taking the stock further down. So the hedge fund managers makes money with short selling in this stock easily. You also can see that the institutional investors has got access to top insider data in advance, so they can bet on the stock in far advance to retailers or the retail investors, and then on the news coming out, say huge earnings of the stock or the stock going for some acquisition, which is a positive news for the stock. Then the retail investors enter the stock, and same day institutions exit the stock and transferring the stocks or the quantity of stocks to the retail investors. So this is like the retail investors brings the stock to higher price by buying it, by increasing the demand. Same time, the institutional investors offloads the stock to that retail investors at a higher price by uh, selling the stocks at which they have bought at a lower price at a higher price as demanded by the retail investors by making higher profits. So they book huge profits and the stock again goes down same day even with higher earnings. So that is why if you see some news is out, the stock is already gone up in the previous days, and on the day the news is out, the stock plummets and it goes down. So that is the trade techniques or the huge institutional investors play. So now that we went into this NSE website, there you can go to the market data. So here you have got market data. Then you go to daily market reports. Here, click on that. Now you go to derivatives. Don't go to capital market. You go to derivatives. This is the F&O thing. Now in that there will be a lot of data. There are a lot of reports. As you see, there are a lot of reports. But in that you go to, so this is for today's data. So go to F&O participant wise open interest. So click on that. So you can download the data here. So you can download it here. So once you click on that, you will get this data. So this is crude data. So I have put it in a neater format, and that is what you see in this slide. So here you have got the client data. So client is nothing but the retail investors, domestic institutional investors, DII, mutual funds or Indian mutual funds and everything, and foreign institutional investors, FII, and you have got the pro. So pro is nothing but proprietary or brokerage firms. So retail investors, DII, FII, and brokerage firms. So if you see future index long, there is this much quantity of contracts. Now future index short, future stock long, future stock short. You have all the data and you have got the total long contracts and total short contracts. So if you take the ratio of this, you add this plus this and divide this by total data, you will multiply by 100, you will get the percentage of long by retail investors, similarly short by retail investors. So that is what is done in this sheet. So if you see the data which we have seen in the last slide, it is been taken out and the percentages of various the total contracts for futures has been taken here. So if you see, majority is like 50, almost 50-50, other than the DIA wherein the short portion is slightly higher, 60%. Rest all if you see, it is all 50-50%. So which is showing that the market is neither long or neither short, means it is not going to go down or go up. It is basically a sort of kind of consolidating phase you can see for the index, the Nifty index basically, or the basically the index which we are talking about. So if you want stock specific, then you have stock positions also available. So you can take that and analyze that in the same sheet. So why we take future data only and not options data is because since in options data they hedge by both buying and selling options. So the options are taken to hedge various positions. So this position hedging can be based on various factors like major events, major incidents, etc. So major incidents in the market can move the market up and down. So based on that, they take options and they hedge the positions. So preserving their original capital or original portfolio. So this is what I was telling. So we take the future data only, the futures data only, and not the options data. Now, if you go to NSE website, again, you will get the options chain. So options chains, I will not explain much here, but basically it is a detailed representation of all available options contracts of an asset, say stock, uh, index, currency, or commodity, and provides a quick picture of all the available past options. It actually protects the underlying asset from any downfall of the underlying asset anticipated. So that is why somebody takes an options trade, especially the institutional investors, to hedge their position and to protect their stock, uh, and to protect their portfolio. For an example, say in this you will get the ask price, bid price, etc. And what is the options chain in this? Basically the positions. This is basically the index, the Nifty index options chain. So you can see how much volume is there. What is the options chain here? Because there is a bid price here, and if you see, if somebody say FI is having a huge position in index, and if they want to, if they think so, they have big exposure to index. Say they have got index heavyweights, say major 10 index heavyweights is there in their portfolio, and they want to hedge the position. Say they have a news that the market is going to fall temporarily for next 1 month. So what they will do, they will buy an option, or they will take a option position in which they will ensure that they will, even though the market goes down, they will make money. So they will buy a call option, or they will sell a put option wherein they will hedge the position. So they will take a opposite direction of the market, and once their stock portfolio goes down temporarily, which is a paper loss only, but by that time the options price will go up, and they will earn money in options, and they will have a temporary loss on the stock. Once the market recovers, as they are having a long-term stock holdings, then they will make profit in the stocks, and by the time they would have exited the position in the options. So it is like an hedging. So the options chains data gives you the entire positions of the major option sellers. So these are major option sellers are mainly the institutional investors only. Now getting to the open interest or OI analysis. So this will be for both futures and options. So option chain is actually for options only, and OI analysis is for both for futures and options. So in that, if you see, there are various companies also mentioned here, and their open interest is shown here. So basically, an OI, which is the open interest analysis, is a number that tells you how much contracts are currently outstanding, which is open in the market. Basically, the OI increases when new contracts are added, and OI decreases when contracts are squared off. So OI does not change when there is transfer of contracts from one party to other. Unlike volumes, OI is a continuous data. So this is all about OI analysis. So this I wanted to include so that you should understand the analytical part of the trades as well, especially the futures and options, so that you will analyze, or you should know how the big investors are taking positions in the various trades. So as per me, traders are having a biased mentality. The psychology of the trader is what decides the way forward. Technical analysis is all based on this basic understanding of psychology of the traders. So in my session on George Soros's reflexivity analysis, and also the Alchemy of Finance book, I had mentioned that how the market is reacting to the understanding of the market participants, or the thinking of the market participants about the market. So if that concept is clear, technical analysis is all based on that only. Technical analysis can always be faulty and go wrong, but never the fundamental analysis. And 99% of the cases, I can strongly tell that fundamental analysis is what which will have a correct outlook or result compared to a technical analysis wherein everything can be manipulated by the market participants, especially the huge institutional investors. So if you see, all the traders do trade to have a profitable ending or profits out of that trade, but they think like everyone. We don't see things as they are, but are seeing things as we are. So that's the basic problem with a trader who is having a lot of adrenaline in his body and trying to look for some great profits, a quick gain, which actually doesn't give him, but end up making money for the huge institutional investors. And these institutional investors also require the retail investors to come in and participate in the trade, so that they can hedge the positions, and their losses can be, the retail investors loss can be converted to the profit of the huge institutional investors, so that they can hedge their position by making money and also protecting their portfolio. So for that only they are bringing in operators, market manipulation, market makers, etc. These all parties, brokerage firms, everything works closely to make a loss for retail investors, I would say, so that the institutions make profit out of that. And also institutions can also lose some trades wherein this is actually not a loss, because wherever they lose here, they will gain on their portfolio holdings. So it's an hedge wherein they don't lose or gain as well. And so it's like either an hedge or a profitable trade. This is what a major institutional investors will have, unlike a retail investor wherein majority times he makes a loss, which also the data is showing. So it's like if you see a carnivorous plant which is eating the insects, so the plant, it tempts you. So you need to understand whether it's a insect eating or a killer plant or a beautiful plant. So it is for you to, you as a intelligent investor, to analyze the scenario and understand what is the real situation and act intelligently. So if you see, the major takeaways here is that don't trust anyone, but your research and conviction only has to be looked into. You have to do your thorough research and then your conviction. Stay away from hyped stocks, because they can actually put your money at great risk if you trade in them. Look for volume patterns for possible manipulation, because as I told, the institutional investors may place large orders and they can cancel the orders as soon as the retail investors pitches in. So the volume patterns will show if such a manipulation is happening. Stick to your fundamental and reflexive analysis. Don't believe in what others are saying. Stick to your circle of competence. Don't over diversify. Like 8 to 15 stocks in your portfolio is good enough. And also regarding the trade, try to, if at all you want to trade, then study a lot, be specific on a few stocks which you know well, and only use trades for hedging your position, not for making unwanted profit, which really you will end up making losses, as I mentioned in this session. Closely monitor position of institutional investors. As I already told you what are the how to analyze the trade data, then you will know what is the position of institutional investors. Never go against institutional investors, because they know the market well in advance to we retail investors. So it's better to follow their positions and act accordingly. Avoid herd mentality, because if everybody is thinking in the same thing, so actually the big institutions are making them to think like that, and then definitely they will go against that. So avoid going like a herd. So take a contra bet, stick to the institutional investors positions, understand that, then take your positions accordingly. Do not be fooled by media analysts or fake news. So they bring in a lot of manipulative news. The channels or the news are actually paid by those investors, big institutional investors. So never go behind them. Have your own conviction and take your positions accordingly. And last, have a long term view. Invest, I would say, better than trade. So trades are actually things which are done by big institutional investors to hedge their positions mainly and to make some profit. They actually have a long term view on their major portfolio, and longer the time you give for a security, the higher the profit it makes. So don't be fooled by the short term view, blind view. Don't be blinded by the short term quick money making thing. So majority traders are making loss only. So you should understand this reality and gradually put in your amount like SIP or short averaging of various stocks once they go down, and stick to your fundamental analysis, which will fetch you profits in a longer run. So this is all about the secrets which is related to institutional investors, how they trade, how they make profit, how they fool the retail investors. So you as a retail investor should be very cautious. Nobody, I'm sure that nobody would have done such a video wherein they are exposing the real facts behind trading. Everybody is like trying to sell their product, sell their courses, sell their ill ideas about trading and trap the investors. So if you see a real trader, or if you see, I have never seen a scenario wherein the majority of the traders are making profit. They actually lose, and institutional investors are very powerful and they know everything and they will do everything to make your trade a big loss so that they gain out of it. This is all about the game. So stick to your fundamental analysis, do your own due diligence, and really think, have a second thought whether you should trade or you should invest. Hope this session was useful for you. If you like the content, please do like and subscribe our channel. Please share it to your friends and other people, so that the efforts we are putting in really gets to the needy people and they understand the subject and they give quality comments, so that I can come up with new similar videos as well. See you in next video. Till then, happy investing.